Welcome, market participants. I'm Van Hesser, Chief Market Strategist at KBRA. I'm joined today by my colleague Gordon Kerr, our European macro strategist sitting in London. Gordon and I have just published our forward looks for Q1, our reports that highlight what we're watching in our respective markets over the next 3 months. So Gordon, let's start with you and pick up where Davos left off. Europe took a beating, again, it seems like, at the World Economic Forum. What's your take on how they are faring in the New World Order?
Thanks. It does feel like Davos is a bit of a Europe bashing moment for a number of participants, but this year started off with obviously the Greenland scenario, which created a bit of turmoil in the markets. But for Europe, I think it's worth taking a bit of a step back and thinking about how they are looking a little bit longer term. They've adjusted to this new world order that we're facing and have made two major trade deals in the span of a month. The first one being Mercosur, which is a trading bloc in the South America where they have entered into a new free trade agreement. And the second one being one just announced recently is India, where they've been negotiating for a considerable amount of time, but have finally come to an agreement where they have lowered tariffs and reduced trade barriers between EU and India. Added to that, we have the German and broader European fiscal spending, which should help to provide some stimulus into this year. They were announced last year and have sort of been, in typical European fashion, a little bit slow to come to the table. But from a European perspective, to be able to do this in a matter of a year is actually quite constructive. And that money will start to hit the actual ground this coming year. On top of that, you have the broader corporate increased capex, which has been globally happening around AI and data centers and all of that, as well as from a European perspective, a positive monetary position with low interest rates at the short end of the curve and low levels of inflation. You add to that, broadly speaking, what has been a negative 2024 and even a large part of 2025. We've seen sentiment starting to turn more and more positive, both from a corporate perspective as well as from a consumer perspective. Still a little bit more negative on the consumer's perspective, but turning more positive on a corporate perspective. So what about you, Van? For all of the political drama and headlines in the U.S., the economic news has been really much better than expected. What's your take?
You're absolutely right, Gordon. I think it's better than certainly markets have expected if we go back to where we were over the course of most of 25. But what's been driving the economy, if we get past the headlines, has been the tech capex that you mentioned, especially related to AI, and we expect that to continue. In 2026, there's been a historic wealth effect from the extraordinary run-up in stocks. And so even though we are living through this so-called K-shaped recovery, that top prong of the K, which has been driving the aggregate numbers, has benefited again from this huge wealth effect from the run-up in stocks as well as residential real estate values. And finally, there has been reduced policy uncertainty on trade and on the path of rates over the course of the year, which has allowed economic actors to move forward with things that, if we go back to the spring, they may have been paralyzed on a bit. So all of that has brought U.S. economic growth above potential. We've taken up our own estimates for growth in the U.S. in 2026 to 2.4%. And accordingly, we also expect, double-digit earnings growth and well-behaved labor markets as a result. So all of that forms a really constructive backdrop for risk assets in 2026. All right, so let's go back to Europe and talk about credit fundamentals and what's driving valuations. I think in Europe in 2026, what should investors be watching out for from your perspective, Gordon?
Yeah, for starters, as you highlighted, the credit cycle, actually, we're kind of in a benign period. We have low levels of defaults. We have low refinancing costs. We have an improved lending environment. The banking sector is actually quite sturdy and stable, which is all, again, supportive for that capex that both of us have mentioned. And if we look at the actual economic side of things, growth is turning a corner. It's been relatively benign, and but things are starting to ramp up. We've seen an increase in industrial production numbers, so starting to turn more positive. We've seen improving productivity in many of the countries, and rising PMIs, so that actual corporate sentiment is starting to turn more positive and head into that productive zone as we head into 2026. In terms of that's all the positive, but in terms of the things that investors should be watching out for, I think to me there's a bit of a bifurcation in the inflation picture in Europe. China and the high valuation of the euro are likely to cause a little bit of an undershoot. China turning a lot more products towards the European region, and as a result, reducing inflationary pressure. So we're likely to see an undershoot, but I think that's largely been expected by the market. And then in terms of a rise in the risk of a rise of inflation, what we are seeing is a rise of raw material costs that are starting to build, which could impact costs. If you look at the Bloomberg Commodity Index, you've seen that it's actually risen about 20% in the last few months. So there is a growing picture in which you can see some inflationary pressures starting to come in, and it's something to watch out for as we head into 2026. The other is the actual progress on the top level from a political perspective in Europe is actually quite strong. They're more constructive about movement forward and the drive to be more competitive internationally. However, when you step down a level, you are starting to see some internal politics which are blocking some of those changes. The changes that have been suggested by Mario Draghi and Mario Letta have been slow to be implemented, and a large part of that is the actual system, the bureaucratic system within Europe, which is slowing things down. Prime example being the decision to turn the Mercosur trade deal over towards the legal department to have them review the actual trade agreement. So slowing down that process, which is something which should be constructive, is being slowed and put slightly on the back burner. If I were to turn things around and say back to you, Van, when you go and look and sift through all of the noise that you are seeing in the U.S., what should investors pay attention to in the first quarter?
Consistent, I think, with what you're seeing in parts of Europe. The path of inflation, I think, is still very much a question here in the States. We heard Jerome Powell at the FOMC presser yesterday sort of reference it. We're up sort of 3% year over year, obviously well above target. What we're concerned is that heading into midterms, you're really seeing the economy run rather hot, right? This comes from stimulus that is due to hit in the first quarter. That's stimulus from both infrastructure spend, from the infrastructure bill, as well as tax cuts and incentives that are coming out of the One Big Beautiful Bill Act, right? All of that is going to hit, we think, in the first quarter. We've also had, remember, 175 basis points of rate cuts in this rate cutting cycle, and we quite possibly could get some more. And again, it takes obviously, 3 to 6 months or more for a lot of that to really flow into the economy, which then now puts us in that first half due to see the benefits of those rate cuts. And again, back to the midterm story, heading into midterms, right? We are seeing a number of affordability initiatives coming out of the administration. Things, subsidies to try and get the housing market going. There's talk of stimulus checks. Again, I would expect a steady flow of these kinds of ideas coming in and fueling economic growth in the first half. So put it all together, and again, the path of inflation, I think, is still very much, or should be very much, on the minds of fixed income investors as we head into 2026. A second thing we're watching are credit cockroaches, right? Remember Jamie Dimon's now famous or infamous description of some of these high-profile credit blowups that we saw in the second half of 2025, mentioning that, typically where there are some of these, there are a lot more to come. Interestingly, if we look at the big bank results and their own asset quality or loan quality in fourth quarter results, they were really excellent. So we're not seeing, again, where there were some of these things back in the second half of last year, they tended now to fall in that idiosyncratic category, or that's, I think, what we always thought. And sure enough, we haven't seen real evidence of that being the tip of the iceberg, where there's a lot more of this sort of coming out. But I think that still is what every credit investor needs to watch, right? To see if there's something that's going to suggest that some of these late cycle accidents, could really, there's a lot more of that waiting to be disclosed. But so far, the early indicators are that all of that, meaning that loan quality still remains in really, really good shape. But we'll watch it closely. Um, I think the promise of AI needs to continue, right? All of that investment that is one of the real pillars of economic growth in the U.S., that has to continue, not only in terms of dollars invested, but also belief among economic actors that this is going to be truly transformational. Think about the flip side. If all of a sudden there's a slip up somewhere along the way where some of this story uh, comes apart a bit, you would see obviously a correction in the stock market that gets at that wealth effect that we talked about a moment ago, and also could theoretically cause investors on the part of hyperscalers and other interested parties to dial back that investment a little bit. So again, keeping that promise of AI and the economic benefits that presumably come with it going, I think is an important thing to watch as we head into 2026. And the last thing is policy uncertainty, right? So we've said, we benefited from reduced policy uncertainty over the back half of 2025. We've been reminded with recent events that it hasn't gone away, that the administration is still very fluid in terms of its use of things like tariffs. And again, we'll get a Supreme Court ruling on the legality of all of that. But rest assured that I think, again, this administration is pretty well set on redefining the global economic order. And I think investors need to pay attention to, or keep that on the radar about where there might be real economic impact from some of that those policy initiatives. So again, it's a fairly full plate of things that we're watching. We're reminded that in this world where valuations, which we'll talk about presumably in a minute here, are priced at perfection or near perfection. A lot of the world feels really imperfect to us. So keeping all of this going, I think, is going to be front and center for how investors feel about the prospects of that are front and center as we head into 2026. So let's go to the valuation question. I assume I don't assume, I know European spreads are tight as they are in the U.S. Where do you see that going? Does this sort of make sense, or do you think the upside downside to investors is at risk here in terms of where credit is valued in Europe? What do you think?
Yeah, it is one of those scenarios where we appreciate that valuations are tight, but at least from a European perspective, we see little trigger to change. I mean, you could see volatility feeding through from the impact on the equity markets, or from the equity markets, or from other scenarios like the Japanese bond market, which we've seen recently. So there is the ability for other markets to start to impact and create volatility in the European credit markets, but from a fundamentals perspective, those spread levels are actually reasonably justified. The credit fundamentals are quite strong. So we are, as a result, we sort of view this as being volatility, the name of the game. Volatility, as we've seen this month already, is likely to be an ongoing theme where we get sort of geopolitical noise in other markets of potential overvaluation from the AI perspective. So in summary, yes, we are tight, but the fundamentals are sound. There is little margin for error as a result of that. So it's important to pay attention and be nimble and watch out for that volatility. What about you, Van? On your end, is there value in credit, or are we overbought there?
I think we actually continue to like the credit asset class in this environment. So yes, spreads are tight. In fact, I think they're 27-year tight in investment grade, public investment grade. But of course, investors don't buy spreads, they buy yields, right? And those yields now, courtesy of what's happened in the treasury market, where, the 10-year is now solidly in a range of sort of 4 to 4.5%, even with that skinny credit spread on top of it, these are reasonable yields for investors. And again, we mentioned, sort of this where risk assets are priced. If we think about the relative value of credit versus, say, the rates market, where rates probably are headed lower from here. Um, Again, with credit being a nice yield pickup over both what you could get in the cash market as well as in the treasury market. And especially relative to stocks, with where stocks are valued in the 90 plus percentile. I think there is room for, a fixed income allocation and a credit allocation, back where, credit portfolios are now, and the yields are meaningful ballast against, those very frothy equity valuations. So, we do think of, this world where, again, there's a lot of imperfection out there, things that we have to watch, potential sources of volatility. Credit fits nicely in there as long as we stay out of recession, which we think those probabilities remain relatively low. Again, the credit asset class, as a diversifier, as an income source into investor portfolios, I think, continue, from my perspective, I continue to see real value in the credit asset class today. So again, lots of things to watch. We lay out a lot of these things in our respective reports. You can access these reports, again, our forward looks, a European version, a US version, are on our website, kbra.com/macro credit. Thanks for dialing in today or tuning in, and we'll look forward to the ongoing dialogue. So on behalf of my colleague, Gordon Kerr in London, I'm Van Hesser. Thanks for joining us today.